Right, good afternoon everyone. Welcome to today's Thames Valley Chamber of Commerce webinar on the budget 2021. Before we begin, a bit of a fun fact for you, I believe. The Chancellor used the word honest 6 times yesterday when delivering his budget speech. I'm delighted to be hosting today's webinar with top 20 chartered accountancy firm Saffery Champness. If you were in any doubt at all, that's me, your host for today, Sandy Rana, account manager here at the Thames Valley Chamber of Commerce. Feel free to get in touch if you do have any questions. There will be time for Q&A at the end of the session, so can I kindly ask that you hold off any exciting questions that you may have until the end. I'm now going to hand over to our panelists this morning, or this afternoon in fact, and speakers, who I'm sure will present an honest examination on the significance of the Chancellor's announcements. Over to you, Sheryl.
Thank you, Sunny. That's lovely. Yes, I mean, just to introduce myself and Clare, as Sunny said, we are Saffery Champness are a national firm of accountants with offices around the UK, but both Clare and I are based in our High Wycombe office, nice and local, where we specialise in working with SMEs and business owners, advising them on tax planning and business strategy, as well as ongoing compliance matters. Sunny said yesterday's budget was a bit unusual, a bit of a balancing act for the Chancellor. Obviously, businesses still need a lot of support, even as we start opening up from COVID lockdown. Yet at the same time, the government has borrowed more than it's borrowed at any time in peacetime history, and that can't be sustained long term, particularly if interest rates increase. So the budget was really twofold, looking at what additional support will be given to businesses over the coming year, and then going forward, how are we going to pay for that? So we'll look to summarise those issues, covering the topics that are mentioned on the slide. We'll also talk very briefly about the sort of things that weren't covered as well, because there were a lot of rumours about potential tax increases which didn't come into effect. So if we start by looking at the COVID support packages that were announced, as already leaked by the press in advance of the budget, furlough is going to be extended now until the end of September. There will be absolutely no change from your employees' point of view. They will continue to receive 80% up to a cap of £2,500 per month. However, from July, employers will need to start contributing 10%. And in August and September, their contributions will rise to 20%. For the self-employed, further assistance was announced as well. There will be a 4th grant covering the period from February to April. That will be on the same basis as the existing grants, i.e. 80% of average earnings. There's then going to be a 5th grant for May, which will be slightly more complicated. If your turnover has decreased by 30% or more, you will be able to claim 80%, as you already have. But if your turnover has decreased by less than 30% during COVID, you will get a grant of 30%. The Chancellor did mention that these 2 additional grants will be available to the new self-employed. So people that weren't able to claim the first 3 grants because they'd only just become self-employed at the beginning of COVID will be eligible for these, as long as they have submitted a tax return by midnight last night. The people that won't be helped, though, are business owners of small companies who are taking dividends. There's been no change to the criteria for self-employed. Business owners are still excluded if they were taking their remuneration by way of dividends before COVID. Just a couple more bits on that. Universal credits will continue for another 6 months, and there were further grants announced as well. And further business loans, the Chancellor called them recovery loans, will be available until December. The amounts of the loans will range from 25,000 to 10 million, and the government will guarantee 80% of those. So I'm now going to hand over to Clare, who will talk us through personal tax.
Good afternoon, everybody. Yeah, I'm just going to go through the personal tax changes that were announced yesterday. It's not going to take me very long because the changes were quite minimal. But initially, there's going to be the increase in the tax allowances from April. They had already been widely publicised, so the personal allowance is going to go up to 12,570, and the high rate threshold is going to be increased to 50,270. After that, it's going to be frozen for 4 years until 2026-27. He's called this fiscal drag to try and drag the money back into the pot. The freeze also affects other allowances such as the pension lifetime limit, which is currently set at just over £1 million, so that won't change. And also on the pension allowance, that will remain at £40,000 per annum, and the tapering still comes in at £240,000 worth of income, and that is then a minimum of £4,000 worth of contributions that you can pay. The CGT annual exemption again is remained at 12,300, halved for trusts at 6,150, and the IHG nil rate band again frozen at 325,000 for the next 4 years. So the Chancellor has called this a progressive policy, but very high earners don't actually get a personal allowance anyway. So if your income's over 100,000, you don't get a personal allowance. So there's not much change for them on that side of things. The tax impact for a top rate taxpayer of the increase in the high rate threshold is around £1,500 in tax over the next 4 years, and then an annual charge thereafter around £600 per annum. The allowance freezes ignores the additional rate threshold, which has been unchanged since 2010 at 150,000. And now over to Sheryl on the business and corporation tax.
The major tax changes that were announced yesterday were on the business and corporation tax side of things. So from a positive point of view, the Chancellor announced that losses can now be carried back for 3 years. So at the moment, if your business or company makes a loss, you can carry those losses back against the profits made in the previous 12 months and get a refund. If you've still got surplus losses after that, they need to be carried forward until you make profits and offset them against future profits. So by extending the period you can carry the losses back for 3 years should enable loss-making businesses to get additional cash refunds rather than carrying forward their losses. The change relates to losses arising in the period from April 20 to March 2022, so it does apply to the year just ending as well. And as said, both companies and unincorporated businesses can take advantage. It does only relate to trading losses, and there is a cap of 2 million of losses, which has to be spread across a group. The interesting thing that was announced is that this claim for loss relief can actually be made outside a tax return. So we haven't seen the small print yet, but what we understand that means is a loss-making business can actually claim to carry back the losses and get a tax refund before finalising its statutory accounts and filing a corporation tax return. So hopefully this will help the cash flow of struggling businesses who can apply for this refund immediately. Okay, on to the next slide. Thank you. So just a few points of how this will impact on unincorporated businesses. The carryback rules will apply to 3 tax years. You can only carry the losses back to offset against the same type of trade. And also the self-employed unincorporated businesses will get an NIC refund, national insurance refund, as well as an income tax refund on the losses carried back. It can be applied to furnished holiday letting businesses, but not to normal property rentals. Okay, so what the Chancellor gives with one hand, he then takes away with another hand, but not until April 23. So he announced the corporation tax will rise to 25% from 19% from the 1st of April 23. He made a point of announcing that 25% was still the lowest tax rate in the G7. and that is factually correct. However, UK tax law doesn't allow as many deductions as tax law in some of these other countries. So in actual fact, from a corporation tax point of view, we won't be the most tax efficient country in the G7 anymore. Sorry, Sunny, back again. The small companies with profits of less than 50,000 will still pay corporation tax at 19%, and then there will be a tapered rate. So the effective rates of tax will be 19% on profits up to 50,000, then 26.5% on the next 200 of profits, and then above 250, you'll be paying at the full 25% rate. Again, haven't seen the small print, but we're assuming these bands will be shared across the number of companies in a group. So if you've got 5 companies in your group, you'll only be able to have 10,000 of profits in each company at the small company rate. Thank you. We don't think that investment companies, including family investment companies, will qualify for the small profit rate. And the interesting thing we calculated was that the effective rate of dividends now, assuming you're a higher rate taxpayer with income of over 150,000, moves from 49.5% to 53.6%. So that's the combined tax you pay on every £100 of company profit you take out. So that includes the corporation tax you pay and the dividend tax. So 53.6% is obviously quite a high rate. The other big announcement is what the Chancellor called a super deduction for capital investment. Unfortunately, this deduction allowance only applies to companies. It doesn't apply to unincorporated businesses. But what it means is if you spend £100 on plant and machinery, you actually get to deduct £130 from your profits that you pay tax on. It will be given as a first-year allowance, so you will get the tax relief in the accounting year that you buy the asset, and that compares to the current annual investment allowance of 100%, so 130 instead of 100%. Small point there, for integral features such as building works, wiring, you'll get 50% rather than the 130%. 6% is the current rate of relief. Okay, just some small points on that. The assets have to be purchased after the 1st of April this year, so next month. Any assets which you're contractually obliged to buy already will be excluded. It also excludes the purchase of used or second-hand assets. So it's only relevant to new assets that you buy. So it has to be a new van, not a second-hand van. However, if you are buying second-hand assets, you will still get the 100% annual investment allowance that's currently available. It relates to expenditure in the 2 years from the 1st of April 2021 to the 31st of March 2023. And as is currently the case, when you sell that asset, if you make a profit on it, you will pay a balancing charge. Okay, so Claire is going to finish up for us talking about VAT and stamp duty.
Right, so VAT, the temporary reduced rate for the hospitality sector has been extended, so that 5% rate remains in point until 30th of September, and then that will increase up to 12.5% until 31st of March 2022. So the hospitality sector includes things like hotels and holiday accommodation, catering and visitor attractions such as zoos, theatres and museums, etc. There is no anti-forestalling procedures in place, and therefore this gives the businesses the opportunity to fix a time of supply when the rate is still at the 5% by issuing invoices earlier than you would normally. Then there's this new rules for the repayment of the deferred VAT. Originally, you could defer the payment of your VAT back in March, April, May and June 2020. They're now saying that you have to repay that by the 31st of March unless you apply for a monthly payment plan. The monthly payment plan is not an automatic procedure. It's something that you have to apply for. You can apply for it by contacting the VAT office, or you can actually do that online. You need to put a payment arrangement in place by the 20th of June. Otherwise, they will charge you a 5% penalty. So you need to make sure that that's in place before the 20th of June. And then on to stamp taxes. This was a bit of an unexpected extension by the government to say that the nil rate band is going to remain at 500,000. And this is going to be up until 30th of June. From July, it will then go down to 250,000, which is a saving of about £2,500 per property. So very good for the property market here. And then finally, what wasn't covered? IR35 and the new off-payroll working provisions. This was already legislated for, and there was some hope that this may be delayed, but it isn't being delayed, and it is coming in from April. So this does need immediate action if your clients or yourselves need to look at your consultants that are working for you or intermediaries. Saffery as a firm have some very good specialists in this area, so if you need any assistance in this, then please do get in touch or contact me or Sheryl. And then the other things, like Sheryl touched on earlier, there were big rumours that there were going to be big changes to capital gains tax and inheritance tax. None of that happened, but it doesn't mean that it won't happen in the future, so we just have to keep an eye on that to see if any changes come in. And that's all from me.
Okay, so generally quite a bit shorter than we would expect, but so was the Chancellor's budget. Very, very little on tax changes in the near future. But happy to take any questions that you might have.
Yeah, definitely. Thank you very much, Sheryl and Claire. Very unsurprising, I think, is the word to sort of sum it up. Again, if you do have any questions, feel free to put it in the chat box. We've still got plenty of time. I appreciate the webinar was sort of quite short, but as they mentioned, it wasn't any major surprises that came out of the bag. If there aren't any questions, we're going to slowly bring this webinar to a swift close. Moving on, for those that are interested in paying attention to our upcoming events, there's a few that I'm going to mention now. Just wanted to bring your attention to one we have on the 10th of March on a similar topic. We have HSBC, who will be talking about how to manage cash flow through uncertainty. Again, full details of that are on our website. And we have got a question come in from Peter. Good afternoon, Peter. Question for both, I guess, either one of you. Can you give some examples of things that would count for super deduction? Example, furniture, office furniture, equipment, etc.
Yes, absolutely. It's everything that would have counted for, that counts as plant and machinery. So that's vans, as long as they are genuine vans and not souped up cars. Furniture, equipment, all kinds of plant and machinery will qualify. So computers, yeah, it's quite wide ranging, really.
Yeah. Do we know what won't be covered? Have they given a definitive list, or is it?
What won't be covered is exactly the same things that you can't get annual investment allowance for at the moment. So that's cars. It's, well, apart from energy efficient cars, which you may be able to claim. Things such as we said, the integral features. So if you're building a building, you often don't get allowances for that. And there's certain parts of that building, such as wiring, energy efficient lighting, that you previously were allowed 6% for, and you're now going to get 50% instead of the 130. So it should be anything that you think of as genuine plant and equipment used in the business should qualify.
Excellent, thank you. And then one for Paul here. Are there any changes to the VAT flat rate scheme?
No, nothing was announced on that. As I said, all he said on VAT was that the rate would, the threshold would stay the same, and the changes to hospitality. No other changes on VAT at all.
Okay. Any more questions? Feel free to ask them as we sort of slowly move on.
The other thing to mention is Claire and I will now be spending our time meeting with our clients virtually to do pre-year-end tax planning. So just because there haven't been many changes in the budget, there's still the opportunity to look at the timing of your income, to make sure that you're using up all your investment allowances, to make sure you're using up your pension relief. So we spend a lot of time in March meeting with our clients and reviewing that. So as an offer for Thames Valley members, if anyone would like to have a chat or a video call with either of us to review their situation and to discuss the sort of ideas that we'll be talking to our clients, we'd be quite happy to have that chat free of charge for any of your members, Sunny.
Excellent, thank you very much.
We also do have, we've released our budget analysis that is available on our website. You can see the website address there, so feel free to get that or either email myself and Claire and we'll send it over to you.
Brilliant, excellent, thank you. So just sort of picking up where we sort of left off, upcoming events, another one for you. On the 11th of March, for those who trade or have aspirations to expand internationally or trade internationally, we are hosting a webinar with the Berkshire Growth Hub, talking about all things customs declaration. Full details about this and all our other webinars can be found on our website. So that's all the www.thamesvalleychamber.co.uk. There you'll be able to see a list of all our upcoming events and webinars and networking events. And please make sure you book on to secure your place. Quarterly Economic Survey. So it's one of the largest and most representative independent business survey of its kind in the UK. This survey is watched very closely by policymakers such as the Treasury, the Bank of England, and the Budget or the Office of Budget Responsibility. And also attracts a lot of media attention. So please, if you haven't already, please just take 2 minutes of your time, fill in the survey and have your say. Link is on our website. I've also put a link on the chat box here, which I'll do another one right there. It shouldn't take more than 2 minutes of your time. So if you're taking any longer, you're doing something wrong right there. That brings us to the end of today's webinar. Appreciate it was sort of quite short and to the point, but as Claire and Sheryl mentioned, not many surprises, but especially with most of it being leaked already in the press.
There has been one more question come through, Sunny, if you'd like me to cover that now.
I think, yeah, I can't see it, but let's go ahead if you've got it.
Okay, yes. It's a question from Tim Major saying, what are the top 3 tax tips to action before the end of March? I think the first and the most important one is to make sure you don't go over any of the tax bands and thresholds. So obviously you become a higher rate taxpayer if you earn over 50,000, you lose your personal allowance if you earn over 100,000, and then become an additional rate taxpayer over 150. So if your income, say for example, is very close to the 100,000, I would be talking to my clients about what they can do to make sure they don't go over that 100. Whether that might be as simple as the timing of dividends, it might be making some extra pension contributions, as that will raise your higher rate thresholds, or making a charitable donation. The last thing you want to do is just go over a band and start losing your personal allowance. Other things to look at is, again, pensions. They are very tax efficient at the moment. You get tax relief when you make the contribution, and then on retirement you can take 25% tax free. But there is a limit to how much you can put in every year. So if you're looking to build up a fund for retirement, wasting any 1 year's pension allowance is not to be advised. So I sit with all my clients and work out what the maximum pension they can contribute each year is, make sure they make use of that. And then things like making sure you use your ISA allowances, making sure you look at junior ISAs, and spreading your savings among the family unit. So they would probably be my top 3 without knowing your personal circumstances.
Excellent, thank you very much.
I would just want to throw one in, sorry, I'll just throw one in there as well about IHT reliefs. People aren't aware of these, that you have an annual exemption for gifts that you can gift to family and friends, etc. And a lot of people miss this, so they go unused each year. So if you want any more information on that, then let me know.
Excellent, thank you. Philip, you've got your call, you've got your hand raised. I don't know whether you can put your question in the chat or Q&A box. If not, I'm going to ask you to kindly put your microphone on and ask the question. You've got your hand up. If you can't, I'll ignore you and move on. It's Philip Waits. Are you there? No, he's not. Okay, not worries. Philip, if you can hear me, you did have your hand up, but you haven't asked the question. So we're going to slowly bring things to a close. So yes, as I sort of mentioned, quarterly economic survey. If you haven't already, I'm going to mention it multiple times. Please take 2 minutes just to fill out the survey. Very important. Doesn't happen often, but government are listening. So make sure you have your voice heard. So that's it. That brings us to the end of today's webinar. Thank you very much again to our speakers and panelists today, Sheryl and Claire. Much appreciated for your time, and hopefully see you all both soon. And I hope everyone stays safe and well.
Thank you,
Thank you very
Sonny.
much. Thank you.
Bye.